The Property Show is offered to you by Thomas Oliver. Outstanding financial services. No confusions, just solutions.
The Property Show is produced by Iro Livanou and presented by Karl Knipe, partner at the Kings Group Estate Agency.
Good evening and welcome everyone. It's great to be back with you all, and hope you've all had a great summer, and we've been away for a couple of months. Yeah, good evening. I've got with me some great guests this evening. In today's show, we're looking at the tax changes that have already been implemented by this government on the property sector, with a view to snatching and grabbing the hard-earned landlords' investment money built up over many years, and those further tax laws that are in the pipeline and coming our way, and not good. We've got a lot to get through, including what are the tax changes, is it worth keeping buy-to-let properties in the future, how will these changes impact the bottom line for landlords, is there a better or more profitable alternative or alternatives out there going forward in the new Treasury tax rating world. So I've got with me two guests this evening. Welcome Simon Todd from Engaging Tax.
Thank you. Hello, Karl.
Welcome Tony Wassell from Partners Wealth Management. How are you?
Karl. I'm very good, thank you.
Good. Let's start with Tony. Tony, in your early career, you were a chartered accountant working for various corporate entities. Around 15 years ago, you embarked on your second career as a financial advisor, a career in which you've also obtained the coveted chartered status. You tell me this change was brought about by a desire to make a difference to the lives of individuals, acting as their trusted advisor. Is that right?
Yeah, very much so. When I was in accountancy, I was just preparing figures for companies, and you don't actually interact with anyone other than internal. And when you're acting internally, you can't really change a huge amount in the same way you can if you're interacting with an individual and advising them and helping them in their life.
All right. So you work in the wealth management area mainly with professionals who are cash rich and time poor.
Yeah, absolutely.
I think that's probably the biggest problem for everyone these days, time poor. It's just whether you're cash rich, isn't it, I suppose? And these sort of people really need someone to take control of their financial affairs. Is that right? They just need that extra help, that extra impetus.
Absolutely, particularly as within financial planning the rules change on a regular basis, the same way with tax, as you'll discuss with your listeners later on buy-to-let. The rules are constantly changing and the products are constantly changing.
Okay.
As soon as people mention pensions, everyone has a view on them, and they're constantly changing. You need to talk to an advisor to figure out what's going on.
Outside of work, you like playing hockey at the weekends? AstroTurf, not ice?
Yeah, me, I'm not built for ice hockey.
What is it? Speed, not comfort. Is that
absolutely.
What it is? Yeah. All right. And you enjoy travelling, don't we all?
Yeah, absolutely.
Says he, having spent most of the summer in Port au Banús.
Yes. I was in Australia and New Zealand.
Oh, you were? All right. Well, you're a bit further away.
That was the winter.
Simon, you're a chartered tax advisor with over 25 years in professional practice. Welcome.
Thank you.
You've worked in a number of London-based tax practices, and prior to founding Engaging Tax in 2004, you were head of tax with the wealth management arm of a premier global wealth management firm. Is that right?
That's right. Actually, that's why I met Tony.
Oh, it is?
Yeah, it is. But what tax and financial planning goes hand in hand.
Right.
When you're trying to assess what somebody's future is, financially, you need to know what the tax burden is going to be that matches that. And then 4 years ago, my partner and I decided that we didn't want to commute to London every day, and we live out of London, and decided to set up a tax practice and offer our private client and tax services from there, which has been great fun.
Okay, that's great. You've got a thorough and detailed understanding of income and capital gains tax planning, which is obviously why you're on the show this evening. Not for your looks for radio, as I said earlier.
Thank you.
No, I'm only joking. And structuring for UK residents individuals as well as those who are resident but non-domicile, yeah?
That's right. I mean, I think that's, from a tax perspective, that's one of the more interesting areas that you can help somebody if they've got the right tax circumstances.
Okay. Well, I know that our listeners, this is something that they're from the feedback that we've had, that they're very interested in all these tax changes that have taken place, are going to take place, and how they can mitigate some of that. But before we get our teeth right into it, I'd just like to say to the listeners, if anybody would like to call in with any questions on 0208 346 3345, That's 0208 346 3345. Or you can text us if you're a bit shy, and I know some of the community is a bit shy out there, because we have tried to get a couple of people on to argue on behalf of them this evening, and they're all a little bit shy. But you, by all means, text us on 0737 661 1033. That's text on 0737 661 1033. Okay, gentlemen, well, let's get started. So let's look briefly at the individual tax changes. I think this is probably an area for you, first of all, Simon. Individual tax changes that have or are happening over the next few years.
That's right. There have been a number of changes since 2016 which have affected the buy-to-let landlords, both in terms of acquiring their properties, assessing their income to tax, and then administering their tax obligations going forward. From 2016 onwards is when the revenue really started to increase the flame of the tax burden to buy-to-let landlords. Certainly buying properties from April 2016, if it was your second property, then there was an increase immediately in stamp duty land tax costs of 3% on all of the different tax bands. Also from 2016, there's been a change in how you calculate your allowable expenses, which really has affected those people who had furnished property, furnished lettings.
We've got somebody already on the line who'd like to ask a question, so can I pause you there, and if we could be put through. So, who have we got on the line this evening? Hello.
Hello.
Hi, who we got on the line this evening?
Hello, I'm Luke.
Oh, hi, Luke.
Hi, Luke.
How are you?
Good, thank you. How are you?
Very good, thank you. You got a question for the guys?
Yes, please. So, my family, we moved from Corfu back in the 50s, me not personally, my parents.
Yeah.
And we've bought lots of investment properties in and around London. But what does the panel's view on the new high rate stamp duty? It seems really unfair to investors in property. Why should they be paying higher stamp duty?
That's a very good question. Guys, why should people be paying higher stamp duty?
I think originally it was a political decision to try to cool the market, and especially...
Quite ironic, it was taken by a Conservative government, not a Labour government.
Sure, but I think there was also something in the press only a few weeks ago suggesting that it wouldn't be surprising if this autumn that stamp duty premium was actually increased above 3%.
Really?
Yeah.
Wow.
It's an easy way, it's an easy tax take, and I think the Treasury can look at it as, if you're lucky enough to be able to have multiple properties, you're lucky enough to pay a higher rate of stamp duty.
Well, what do you think? What do you think about it, Luke?
Yeah, I don't think it's fair. I don't think it's right. I don't see how it's going to help with the housing crisis. I think, have you heard of this patriotic retirement plan? I think that's got more of a chance of helping with the housing crisis than increasing stamp duty.
Yeah.
Well, actually, Luke, I think just on that point, and has it increased stamp duty? As I understand, again, the last quarterly results of published stamp duty costs have gone down.
Yeah.
So they can increase it, but it's not taking any more tax.
Yeah, I think the point Luke's making is that at the end of the day, the housing stock is, to some extent, it's just not increasing anywhere near the amount that it needs. So all we're doing is really we're taking properties out the rental sector and keeping prices down in the private sector. Ultimately, that's only going to mean that rents are going to have to go up, I would have thought. I don't know. Would you think that, Luke?
Yeah, I do. But I think the solution is, I can't take credit for the retirement plan idea, but they say there's about 10 million people that are over 50 in the workforce, and if you give each of them £1 million severance for early retirement, and then stipulate that they must retire, then that opens up 10 million job openings. If you stipulate that they must buy a British car, then 10 million cars will be ordered. That fixes the car industry. If you then say they must either buy a house or pay off their mortgage, I think that would help the housing crisis. And then if you say that they must send their kids to school or college or university, then that fixes the crime rate. And then if you say they must buy £100 worth of alcohol or tobacco a week, the government gets its money back in duty and tax. I don't think it could be easier than that.
Well, I think there's some good ideas there. We'll bear those in mind, but we've got to move on. Thanks for calling, Luke. It's lovely speaking to you. You have a good evening.
So, thanks, Marston.
Thanks. Bye-bye. Luke's got some... What should we say? Very interesting ideas, sir.
Sure.
Yeah.
I'm sitting there thinking I'm actually going to retire tomorrow if the government gives me £1 million. Thank you very much.
I'll retire tomorrow. If everyone's got £1 million, you'll be in a great job. You'll be doing really well.
Someone can have my job.
There'll be
carry the show,
okay, so sorry, we'll carry on for where we were there, Simon. Talking about these.
So
areas.
other changes from 2016 is those landlords who had furnished properties where they used to claim the 10% wear and tear allowance. That's now been abolished, and there's a specific relief called replacement of domestic items.
I mean, that could add up to quite a lot of money if you've got quite a few properties, couldn't it?
Well, sure. I mean, you were effectively being given 10% of your gross rent as an allowable expense to cover the replacement items, irrespective whether you spent it or not. So that means immediately only 90% of your rental roll is taxable.
Yeah, so I suppose if you've got, I don't know, a 2-bed flat that you're bringing in, let's say a 1-bed flat bringing in £1,000 a month, and you've got 6 of those, that's 72,000, so that's 7,200 straight away gone.
That's right. As an additional rate taxpayer, that's nearly £4,000 of tax, which now is what they're saying. You've actually got to spend £7,000 on specific replacement items.
Is that, do you think, to improve the rental stock, the quality of the rental stock?
I don't know.
Just to take the tax?
From a tax perspective, I suspect it's merely a number. It's
you've got a very, very facetious mind.
The revenue can probably calculate exactly how much wear and tear is claimed on every self-assessment tax return, and there'll be a number somewhere that says how much is actually spent. So that's one of the changes that came in 2016. Also, other changes which are more relevant for people who are looking at doing their tax returns now, the 2018 tax returns. There were changes last year in relation to loan interest relief rules, and loan interest relief being capped to a basic rate over the next 4 years. There's a property allowance that's now been introduced for the 2018 tax return that will exempt £1,000 of taxable income potentially. Another change on the 2018 tax return that we're talking about is whether you're going to file on a cash basis or an accruals basis, and that depends on turnover.
So really what you're saying is that the market's been, this area's been savaged, really?
Well, perhaps this sceptic would say it's been ignored for a long time, and now...
But this creates a real problem for the community, for our listeners, because a lot of our listeners, these are not people who've sort of been born with a wealthy silver spoon in their mouth. These are people who've come over, worked very, very hard, or their parents have. They've grafted away. They might have been builders, plumbers, local shopkeepers in some shape or form, but they've worked very, very hard. They've invested their money in property over the years. They've built up a nice portfolio. It could be 2, 3, 4, 10, 15 properties, even more, but let's just say 6 or 7 properties through hard work and graft. Why should they have to give that money back? They've paid their taxes anyway. Why should all of a sudden their nest egg be taken away from them? Where somebody else has gone out and they've gone drinking every night and spent their money and done whatever else they've done. I'm arguing on behalf of the community. I just don't think
they've done that,
right.
They've paid more tax, surely, and the government taxing alcohol.
Well, there is that, but I'm sure everyone's paid their tax or whatever. Let's assume everyone's paid their correct tax in the first place, and it just seems that they've been thrifty and now they're going to have this stolen. Well, I only see it as a raid. They're being raided.
Well, it's proof of the number of tax changes, how difficult tax and property is now. I mean, that it's in itself, it's making my industry better as a tax advisor, because more clients come to you saying, we don't know how to do this, even though we've managed to do in the past. What do we need to do going forward? Which is, it's income generation in one side, but it's only because the burden's increasing on that part.
Are you finding that more clients are coming? I mean, I think most, but in the past, I'm only going from what I understand, most people would, if they got 3 or 4 properties, maybe did their tax returns with their friend or whatever, and they were looking at, we're okay, we'll save up maybe in a couple of years' time and buy another buy-to-let. Are you seeing, Tony, that there's more interest in people realising that what they've got, the government's going to try and take it away from them, and they need some help and support?
I wouldn't say I'm necessarily seeing that, but I think that's the idea. I think the idea is to, playing devil's advocate, I think what the government's trying to do is get the housing stock from the buy-to-let market into the ownership market.
Well, it's funny you should say that.
That's why they're taxing what is effectively an investment rather than
It's funny you should say that. I tried to get the new housing minister on, Kit Malthouse, and I contacted him, and his office wrote back and said he was unavailable, amazingly, and suggested I speak to the Treasury. I don't really understand why the Treasury is running housing policy now in this country. I think we all know what the Treasury want. They want to take money off people, so that wasn't the point. The point that I wanted to get was how does the Treasury's policy cut across what is, I don't think anybody knows in this country what is the housing policy. I don't even think the housing minister knows. I think that's half the problem. So maybe in another show, if you're listening, Mr. Malthouse, maybe on another show you'll come and join us and just explain to the listeners exactly what is this government's housing policy. because without a doubt, I've been in this industry 32 years. I've never seen a lack of direction in housing. It's been bad, but it seems that we talk about housing being a great topic, and we just don't seem to have any direction at all. Would you guys agree with that?
In a word, yes.
Sure. You can have more than one word.
It was a loaded question, wasn't it?
Well, no, not at all, really, because you might think different. I don't know. You might have ties. You might know. You might have government ties, or you might see that, or you might know different things. I know we were talking off air earlier, and you were saying, Simon, that there's a few things that you've heard that are in the pipeline. You didn't want to particularly discuss them in case they were wrong or right, but there's lots of ifs, buts, and maybes.
Well, I think that there's a lot that the Revenue and Treasury are targeting, and this is a part of the society that the government decide that they can take a greater share of tax than is already being paid. And the key, of course, is make sure that the taxpayer, the landlord, pays the right tax. Not too much, not too little, but the right tax. Yeah. And that's the challenge of the tax advisor, and that's the challenge of the landlord, to make sure that they put themselves in that position. I mean, I think what I'm more worried about going forward, Karl, is something called Making Tax Digital, which is a huge change that all of us who are involved in tax, both as tax advisors and as people who file tax returns, are going to suffer, or going to come into in the years to come.
How's this going to affect the average person with 3 or 4 properties?
Sure.
Buy-to-let?
What the landlord is going to be required to do is file at some point in the next decade, from 2020 onwards, and it's not been defined exactly when this will come into effect, but probably 2020, that they will have to file quarterly returns. At the moment, they file a self-assessment tax return sometime after 5th of April. But
so you're saying they're going to have to 4 times a year?
They're going to have to file every quarter throughout the tax year,
right,
reporting their income and expenses, and then a summary return after the end of the tax year to include any further claims they wish to make.
That'll be interesting, because HMRC, from my experience, can't even deal with 1 year's tax returns at the end of it. Never mind 4 times a year.
It's daunting, and this is the world of automation that we're having to deal
garbage
with.
In, garbage out.
But I think, as we were saying earlier off air, that I think this is probably a stepping stone to landlords having to pay tax sooner. You're only reporting this information to HMRC in the first instance, but the reality is they'll want to tax that, and it just means instead of landlords paying a number of months after receiving the income, or in fact perhaps years after receiving the income, that they are going to actually have to pay tax much sooner than they're paying now.
Okay, all right, I'm going to go to a break before we come back, because I want to get right into it and have a good run talking about, really, the questions are, is it still worth people doing buy-to-let properties? If so, is there a certain amount they should have? There's quite a lot there, and I want to hear from Tony. I want to hear about what people should really be thinking about, certainly if you've got 3 or 4 properties now, because it seems like the tax world is going to get very, very complicated, and I would have thought that if you're looking to protect your assets, you need to be doing that sooner rather than later. Let's go to a break.
Thomas Oliver, a representative of Openwork, prides itself on high-caliber quality service, with our senior advisor Vishal Gurujani at the forefront. Whether you're seeking advice on a mortgage, life insurance, or a pension, we have the solutions for you. At Thomas Oliver, our financial advisors have a collective experience of over 100 years in the industry. We go above and beyond, trying to meet our clients' requirements in achieving their desired outcome in a friendly and efficient manner. Thomas Oliver is shortlisted for this year's Estas Awards as a mortgage advisor. Thomas Oliver, with branch offices across North London, East London, Hertfordshire and Essex. For further information, please call 01707 872 000 or visit thomasoliveruk.co.uk. Thomas Oliver, outstanding financial services, regulated by the Financial Conduct Authority. You are listening to The Property Show, produced by Iro Livanou and presented by Karl Knipe, partner at the Kings Group Estate Agency.
Welcome back, everybody. Great to have you back. Cool. We've had some hot topic conversation going on in the break there. God, dear me. Lots to get through this second half, guys, and I want to rattle through. But before we do that, just to say again, please call in any of your questions on the tax situation, anything we're discussing this evening. Please call in on 0208 346 3345. That's 0208 346 3345, or text us on 0737 661 1033. That's 0737 661 1033. So, guys, welcome back.
Hi.
Right, so let's straight in there. From a tax perspective, is it worth keeping buy-to-let properties? There's quite a few articles going. Tax changes spark 9.8% drop in buy-to-let purchases. That's from the 12th of July from the Property Reporter. There's landlord exodus. 380,000 landlords plan to reduce their portfolios, says the NLA. That's from an article from the August Negotiator magazine. We've got someone on the line. Hold that thought. Let's see what this caller's question is. Good evening. Who am I speaking to?
Hello, it's Han.
Is who, sorry?
Han.
Pleased to hear from you. Thanks for calling in. What's your question for the guys?
Yeah, thank you. It's a question about capital gains tax. So, I know, like with shares, if your wife's terminally ill or something, you can put like all the shares into her name, and then when in the will it gets passed back to you, the portfolio gets like revalued then, and that is free of capital gains tax.
It gets
rebased. The same with property. Yeah. So like if my wife was dying, right, can I like gift her the whole house, right, and then this is like second property I'm talking about, then she dies, I get it back through the will, and then is it revalued at today's prices? Like, we bought property at like 100,000, now it's like worth about 500,000. So I'm thinking, is that like a cheeky little scam way to save a bit of tax?
Well, it's not something that I've ever come across in terms of a specific request to look at. However,
you might have a few more after tonight if you can.
However, technically, I think that is exactly what happens. You'd need to make sure that your gift to your wife was a recorded transaction, both at Land Registry and at HMRC, and you'd need to get professional valuations at the date of death, which she would need probably for her estate anyway. But I think as a sequence of transactions, I think yes, that does result in an uplift.
Great. I just wanted to check that's really good.
Is that helpful for you?
Yeah, really good. That's really good. And is it just a quick question?
Yeah.
Does it matter how long you've been married for? Because if I was just going to find someone, it's like not very well.
I hope you didn't give us your real name when you rang in there, Hans.
Sure. You probably ought to make sure that your wife's not well either, as well, and doesn't run off to Ibiza or somewhere.
Yes. I think this show could carry a government health warning. Please, just what we say, don't go off and do anything you shouldn't do.
Sure, but that's all right though, is it? There's like you can be married like because people get married in hospitals, don't they? You can be married like for 5 minutes.
You can. I don't think they're being married for tax purposes normally. I'd like to think.
Well, £400,000 is a lot to save, isn't it, on capital gains?
It's a big amount, especially if you've got children and things involved as well.
Yeah. Great, fantastic. I'm off to hospital.
Right.
Cheers.
Good evening. Thanks for calling in.
Bye.
Lovely speaking to you.
Bye.
Well, we're getting a few interesting calls, that's for sure. I'm not sure they're the ones that you guys were looking for or were thinking, but if nothing else, I'm sure everyone's spluttering their tea out listening to some of these things. So, and like I say, I think we better make sure that this is a programme on property and tax, not tax avoidance. Okay?
Exactly.
All right. So let's get back to where we were then. God, he's thrown me off there. So yeah, the point is that it seems that there's certainly a lot in the press about landlords giving up properties. I can understand why that is, but I mean, is this something they should be doing, or?
I think I said to you actually, Carl, during the break, that what I think the government is trying to do is change people's behaviours. Your listeners have been lucky to a large extent that property and buy-to-let property hasn't had a huge amount of changes over the years in terms of legislation, whereas in my industry, where I'm dealing with pensions and ISAs, they're forever changing, so your advisor's got to stay on top of it. What they're trying to do is change the behaviours by making it less appealing so that property does come back onto the market, I think, and is available for people to buy and own, because that's the aspiration. That's what people are bemoaning at the moment. They can't get on the market, there's not enough property. That's all linked into housing policy. Kit obviously would have expanded on it, I'm sure, if he was here, but he's not. Or maybe the Treasury.
Yeah, I don't think the Treasury would have expanded. I'm not so sure the Housing Minister would, because I'm not so sure that they know what the housing policy is. But like I say, maybe he'll come on and explain that to us on one of our next shows. Right, so Should landlords, if they've got 5 or 6 properties, should be looking at a limited company? This is something that's...
I mean, that's a $64,000 question over the last 2 years as to whether that is the way forward, whether you should incorporate your buy-to-let business. And there certainly are advantages from a tax perspective from incorporating your buy-to-let business, but the keys in the tag there, it needs to be a business. You're expected to have at least 5 properties, and you're expected to actually be involved in that business before you can start to think of moving it into a company.
Well, when you say involved, what do you mean? Demonstrating on a day-to-day basis that you're involved in that? You can't put those 5 properties with a letting agent, so to speak.
It's expected that you are actively involved in the rental business, and
could that be the maintenance of the properties though?
Absolutely, yeah. Right, both in terms of assessing tenants and perhaps work on the properties, but for you to transition a personally owned portfolio of buy-to-lets into a corporate vehicle, into a company, a UK company, if you can't make it look like a business, there are substantial tax consequences. If you, as an individual, dispose of a property into a company, that's a taxable event for capital gains tax purposes. So you can immediately crystallise a tax charge at 28%. It's also a stampable. You have to pay. There'd be an SDLT charge on the acquisition,
which could be very substantial.
Absolutely. So to get over all of those charges, because it wouldn't really be worth it to put it into a company otherwise, you've got to be trading, you've got to be seen to be a business.
But then maybe if you own 5 or 6 properties in your intent on buying another 3 or 4, maybe the next 3 or 4 you put into the limited company.
That's certainly, I think that's certainly that the industry is looking at that you've got what you've got, and perhaps accepting it individually is all your option, but going forward, setting up a UK company, and that company being the buyer of the buy-to-lets is a more tax efficient way forward, bearing in mind all these changes, especially loan interest relief being one of the key advantages of being in a corporate, because there aren't those caps on loan interest relief going forward that there are going to be for individual buy-to-let landlords.
It all sounds very complicated. So I think from listening, it is complicated, and things. The landscape has changed a lot, hasn't it, over the last couple of years? I think is that fair to say?
Well, 5 changes in the last 2 years, and I've got 2 changes in the next 2 years.
Okay. Yeah, which, as I said, I think is the government trying to drive behaviours, and it's now picking on, if you like, the buy-to-let market.
So would you say if someone's got 4 or 5 properties, they should be getting advice in some shape or form? Certainly, financial advice, not just from their uncle or...
Yeah, as a financial advisor, you can't give advice on property. Most people are more specialist in property than I am. Yeah. However, what I would say, and I mentioned the B word that we don't usually mention, Brexit, diversification is the key here, because no one knows... This is a
Brexit-free zone, this radio station.
It's got to come into it just once. If you're going into a complete unknown in the next couple of years, we have no idea what the financial impact is. What we do know is the government's already started to pick on buy-to-let and buy-to-let landlords as a way of getting money. Once they start down that route, they usually continue. So my suggestion would be, don't keep building the property portfolio knowing you're going to get hit further and further. Diversify a bit and put it somewhere else to keep your options open and keep some liquid cash post-Brexit.
We'll come to that in a minute, but we've just got a text come in from Mark saying that if the pocket of the landlord is being hit so hard, won't landlords just increase their rents? The policy doesn't seem to help tenants at all. What's your views on that?
I think that's very likely. Yeah. And
because you've got added to this, you've got next year the government's introduced the fact that letting agents can't charge tenants reference fees, which is another situation. Something we'll probably discuss that in another show, because I think that opens up a real big can of worms or whatever. But
as a landlord, you're going to be at greater risk if you decide that you're not going to perhaps go and get all those references, and you're taking a greater risk. Then you've got to compensate that somehow.
Well, I think that I don't want to get sidetracked onto that, but I think the situation is that we're down to the letting agents to do the references and pay for them and somehow get that money back from the landlord, which the landlord's going to be reticent to do. And I think that's going to mean that maybe letting agents are going to really consider, if they've got 2 or 3 people who want to buy a property, which one they think, rightly or wrongly, is probably the better agent, and that could create problems from many angles, I think, going forward. But I mean, Tony, do you think rents will go up?
They will, but there comes a tipping point where people will say, right, it's not worth renting, I've really got to get into and buy somehow.
But if there's 380, I know the figures are all banded around, but if there's 380,000 landlords planning to reduce their portfolios, even if they sell 1 each, That's 380,000 rental properties coming out of the private rental sector. That's got to mean there's a limited supply, a reduced supply, quite considerably, of rental properties, particularly if that's going to be in the southeast, in the London area.
Reduced private rental properties, but in theory it means there's a lot more properties to actually buy outright.
Right.
So as I said, it's a tipping point at which if the rent goes up so much, and there are these properties suddenly coming onto the market where people are not buying and come away from renting because...
And this argument goes back to your point of diversification and changing your asset class out of one particular bricks and mortar and to see what else you should be doing. Which is the future of whether you have 3, 6, 9 or 12 buy-to-lets, or whether you have 6 buy-to-lets and look at diversifying where your wealth is.
So what can somebody, one of our listeners out there, they're listening in this evening, they've got 5 or 6 properties, they're a little bit worried about really what the tax situation is. They've not really worried too much about it previously because it's been relatively simple up to the last couple of years, but going forward, they may be in their late 50s. What should they be doing what's the first step that they should do to potentially lessen their tax that they're going to be hit with over the next couple of years?
From a financial planning perspective, pensions is probably a little bit late, and if you get into your late 50s you can still do a pension, but and because it's accessible in most cases from 55 onwards now under legislation changes, it's a useful vehicle. But simple things like ISAs. Everyone has a 20,000 ISA allowance each year, adults over the 18 that are eligible in the UK. So between a husband and wife, you put 40,000 of cash into an ISA, and it's effectively, once it's in there, it's outside of the tax regime. And it provides liquidity, so it's part of your long-term planning. And a simple investment account. People have a bank account. People don't... the listeners may not necessarily trust anything they can't touch, but they have a bank account, they can't touch that, they see a paper statement. It's the same with an investment account, it's the same with an ISA. Yeah. It's just another product.
I think the problem is with the community, they like to physically be able to touch it, feel it, eat it.
You can't touch a bank account.
That's I think what is the sort of major issues and problems. I mean...
Just can I just add, Carl, one tax-saving idea, and just to make sure that landlords, if they're married, it's really important to make sure that between husband and wife or spouses at least, that you've got a fair share of taxable income split between them. An example would be if you have a single owner of buy-to-let properties with a rent profit of £150,000 and their partner has no taxable income at all. If those properties were owned jointly between both partners, then the overall tax bill I calculate would be something in the order of £20,000 less.
Okay, that's a heck of a lot of money, isn't it?
It is, if that's every year. Yeah. On a
I'm not sure how much the average landlord or out there wants to split their money with their spouse. Depends how well they're getting on with them, I suppose. At that point, I don't know. But £20,000 is a lot of money. A lot of money. You could do a lot of damage with that, couldn't you? Just at this point, because we've got about 10 minutes left of the show, just to say, if anybody wants to call in, now's the time. Yeah, put your tea down. Now's the time. Get a bit of confidence. Give us a call. Ask us a question. 0208 346 3345, or send us a text on 0737 661 1033. That's phone on 0208 346 3345, or send us a text on 0737 661 1033. That's excellent. So, what about SIPs, Tony?
And property.
So, could people put property into a SIP to save tax?
To a certain extent, yes, but a SIP is, for listeners who don't know, a self-invested personal pension. It's just another version of a pension. So if you put the property in there, all you're doing is tying it up in a pension structure.
Would it not be a tax efficient way, though, isn't it?
However, the government did look at allowing buy-to-let property to be put in SIPs or in pensions back in the mid-2000s, around 2005-06, and the number of companies got geared up for it, and then they completely scrapped the idea because they realised there was so many buy-to-lets out there. All they were doing was fueling the market even further by making it even more tax efficient, so they scrapped that idea. So you can't put buy-to-let properties in a SIP.
So what can you? What
you can put commercial property in, to a certain extent, but there's a limited number of SIP providers, i.e. companies who will actually do that for you. It's not everyone, because it's a very specialist market, and of course commercial property comes with its own day-to-day costs and risks.
I think I'm right in saying the commercial property's not got to have any residential area attached to it, as well as it's got to be pure commercial.
I think it can have a very limited amount, almost incidental.
Yeah.
So it's got to be like a warehouse or a shop or similar.
So going back to some kind of policy, ISA, whatever, I mean, how does that stack up financially, do you think, in terms of, it's probably $1 million question, how does that stack up financially in terms of capital growth and taxable income going forward? How, in your opinion? I mean, I suppose it is $1 million question, because we don't know if there's going to be any taxable or any property growth or whatever going forward.
No, we start with the usual warning: investments can go up and down. There's no guarantees in this world, but there's no guarantees that property is going to go up forever. It does, or has done, but it's certainly had its downsides in the late 80s and around the financial crisis. Particularly with ISAs, the governments are very much encouraging ISAs and trying to diversify the type of ISA you can do. So you can put $20,000 a year. If you've put the property between husband and wife and saved you $20,000 that Simon was talking about, you can put it in your ISA, and you've pretty much got out of the income tax.
Double tax efficient.
Yeah, and you've got out of the income tax and the capital gains tax regime. I've been looking after clients who've had ISAs for a number of years and been maximum funding them. The 20,000 has been in place for about 7 years now. And you build up substantial sums of money that are not insignificant. They're very similar to the value of a property. By the time you've finished, if you've been doing this on a regular basis, you think 20,000 for 10 years is £200,000, then add some growth in, and it's very liquid. You can get it out whenever you want, pretty much.
Is there an optimum amount of properties that people should be really having? 3, 8, 20? Is there an optimum amount going forward?
Well, I'm not sure whether it's a property number or whether it's a property value, and that comes to the diversification point.
Yeah.
If you have 10 properties worth £1 million and your total worth is £1 million plus one, then you're obviously hugely undiversified and exposed to all the variations of losses on the market.
Yeah.
If you've got 10 properties worth £1 million and you're worth £10 million, you've probably got the right balance of asset allocation, and that's why you need to sit down and decide what's right for you emotionally as well as what's right financially.
So the problem comes with this for the community is that they've done very well over the last 40 years buying property, and they've been told numerously that they maybe should invest in other things, but so far it's always gone well. What's changed this time?
Well, I think that this is the demographic we're in as to where the Treasury, the government, are going for the tax take over the next 20 years, I would imagine, if not longer. The upper echelons of our society are not taxed at the rates in the 1980s of 95%. The bottom 25% of society don't pay any tax at all, and so there's a slug in the middle, and the property owner is looked at, or multiple property owner is looked at a position who can afford to share a greater burden of the tax.
So they've got to build a castle around their houses, if you see what I mean. Castle around their castles to protect them.
Diversify.
It's
simple, because ultimately if the government does go after the properties and you build up, you've got 8 and you go for 10, you've still got 10 and you're going to get stuck with whatever rule the government decides. At least if you've got 8 and put the equivalent money of 2 somewhere else, you're diversified, you can adjust the impact the government's having on you.
So what you're really saying is people need to really get some advice and help out there, and just listen to it and then decide what you want to do.
Absolutely.
Which is very similar to what we're doing in today's programme. We're just discussing situations. We're not saying what anyone should do particularly, but it's just giving them food for thought, because there is definite sea changes in the political and tax world taking place.
Absolutely.
Yeah. So we had this from our caller earlier on. Estate planning. Well, what would be the best way to offset death duties then? So changes afoot there as well.
Well, I mean, inheritance tax, that's a much broader subject, and
we've learnt something, because our caller came on there, and certainly I've learnt something this night. If I know when I'm dying, I'm going to be definitely putting everything over to my wife.
Well, I think you probably should do that before, as I suggested. If you can.
Oh no, we're not like that in this community. We have to look after everything. Don't want to spoil them. You spoil them, you lose them.
I think you need to... inheritance tax, which is a 40% burden, is something that you need to get proper financial and tax planning advice on, because it has to work both in your lifetime, what makes sense to your family, and And importantly, there's something in place that controls what happens after you die and how you pass your wealth down to the next generations.
I think this is a major issue for the community, for the listeners. I'm not sure everyone realises just maybe how well off they are if they've got 4 or 5 properties that they've got together over 20, 30 years. I don't think they've probably sat down and really worked out what their real true value is, because it's just a paper figure, even though they can touch it and feel it. But that is going to, if you've got 5 properties and they're worth, let's say, £250,000 each, well, that's 1.25 million. That's
£500,000 of inheritance tax eventually.
Yeah, before you've even talked about the house you live in or whatever.
Yep.
So yeah, there's issues there that are really got to be addressed, and that probably leads on to wills and things like that. I'm not sure everyone's got wills, probably not. I don't know the facts and figures on that. That's something we may look at again in a show to come. But there is certainly definite issues there.
With inheritance tax, one of the best ways to save inheritance tax is to give your assets away a long time before you plan to die. So you trust your children. They're at a certain age, they go into their 30s, give them one of the properties, and live 7 years. Get outside your estate. You're going to pass it. You want your children to benefit from your death. Ultimately, that's where you want the money to go, not the government.
Well, I suppose that's one way of thinking about it.
Yeah,
I'm not so sure.
You don't want them to benefit too quickly.
No, not at all. Right. Well, we're coming to the end of the show, guys. It's been really interesting talking to you. But I suppose my sort of final question is that I've got for you both is, where do you think the government's going to strike next in terms of property wealth grabbing, Tony?
I can see them removing more and more reliefs that you currently get.
Doesn't seem like there's that many reliefs left.
There's always something. You said, "Where's the grab?" There's always something. There's always something to go.
There is definitely always something to grab.
Ultimately, when you have a principal private residence, i.e. your own home, you don't get any relief. You don't get any relief against interest. You don't get any relief against wear and tear. It's your home. You spend the money on it. Why not with the buy-to-let treat it the same? That's the way the government could go ultimately. So you don't get anything.
Simon?
I mean, I think there'll just be a continuing increase of overall tax rates in the way that perhaps stamp duty may go up for second properties again, and perhaps they'll carve out a specialist income tax rate for rental income. Who knows?
They already have for capital gains tax on sale of properties.
Yep.
There's already a separate rate for it over and above those investments.
Okay, great. Well, guys, it's been fantastic talking to you. Listeners out there, if there's anything else that you want to find out, by all means text in the show or call. We can always pass any of your questions on to the guys. You'd be happy to respond to them, wouldn't you? I'm sure. Fantastic. Well, we're back. The Property Show is back on Wednesday the 3rd of October next. We'll have another great topic with some other great guests. We look forward to obviously seeing you all and listening to you guys listening in to us again then. I'm sure it'll be another great evening. Enjoy the rest of Wednesday night. I'm off to see my son play in the FA Youth Cup, so wish me luck. Thank you.
Thank you.
Good night.
Thanks,
well done, guys. Thank you.
The Property Show was brought to you by Thomas Oliver. Outstanding financial services. No confusions, just solutions.
Thomas Oliver, a representative of Openwork, prides itself on high-caliber quality service, with our senior advisor Vishal Gurajani at the forefront. Whether you're seeking advice on a mortgage, life insurance, or a pension, we have the solutions for you. At Thomas Oliver, our financial advisors have a collective experience of over 100 years in the industry. We go above and beyond, trying to meet our clients' requirements in achieving their desired outcome in a friendly and efficient manner. Thomas Oliver is shortlisted for this year's Estas Awards as a mortgage advisor. Thomas Oliver with branch offices across North London, East London, Hertfordshire and Essex. For further information, please call 01707 872 000 or visit thomasoliveruk.co.uk. Thomas Oliver, outstanding financial services. Regulated by the Financial Conduct Authority.